Howdy doody dandy. Today we're going to be talking about, yet again, some massacred stocks. That's right, they've been killed. They've been literally killed. First up is a Roku here. Both of these are going to be because of earnings. So Roku's down 16.5% right now, which is an interesting one. So we'll see what would have prompted that. Roku beats by 4 cents on an EPS standpoint, negative 22 cents per share. Okay, not profitable, which is expected. Revenue up 50% year over year, beats by $3 million. Okay, that's not a bad quarter. See if there's anything in the details we're missing here. Net revenues rose by 50%. Platform revenues grew 79%. Gross profit rose 50% as well. Active accounts rose 36%. That's fantastic. Streaming hours jumped 68%. Average revenue per user rose 30%. Platform revenue up. Player revenue up. Boosting revenue outlook to $1 billion for the full year. 48.9% growth from previously expected 46%. Gross profit outlook up from $485 million to $492 million. Where's the negativity here? We'll get into that in just 1 second. First, we're going to look at what the heck is Roku. Roku, they deliver a wide range of products. It's pretty much a platform for streaming services. So it makes your TV a smart TV, similar to like an Amazon Fire Stick, or I guess even Apple TV, Apple TV Plus. So they come base with some TVs: TCL, Sharp, Hisense, Philips, Sanyo, Element, JVC. Here's the garbage brands. RCA, obviously Hitachi's not a garbage brand. Magnavox garbage, and Westinghouse. I own TCL TVs myself, and I'm very familiar with the Roku platform, and I like it quite a bit. That's a base of what it looks like. It's really just it's a very easy to use, in my opinion, platform for you to access any applications you might need. I'm a fan of it. Not only do they sell that, they obviously have just the streaming products themselves. So the Express, and each has a different selection of apps that they involve. And the premium or the Premier is the 4K streaming version, which is fantastic. Obviously, the Express is the cheap model, doesn't offer 4K. The Premier, fantastic. Look at that, 4K. I love it. And we also have the the streaming stick. That's right. The streaming stick's a nice and easy one. Just plug it in the back of your TV. You don't have to have an extra device. Not bad. That's what I'm talking about. Just literally an Amazon Fire Stick. Not bad. And for the price, it's good. And then you get the Roku Ultra. That's right. No cables. Fast channel launch. Lost remote finder. It's got it all for $100. It's got it all. What other products do they offer? That's right, they offer audio products too. So they got the smart sound bar. They have wireless speakers, not bad, and this wireless subwoofer. Love a nice subwoofer, gotta love it. And then accessories, including like your remotes, streaming sticks, and such. So again, nothing absurd here. So I'm personally a fan of the Roku brand, but let's just talk about something for a second. I love talking about valuation of a company. Tell me where the valuation of this company is. $13.7 billion market cap. Yet their full year sales are $1 billion. Again, so obviously this is a company that is way overvalued, and I think that's the entire reason. This is a fantastic quarter. The only reason why this company's going down is because of the valuation, I believe. So, on a 1 month basis, guess what? You're still up 10%. 6 months out, guess what? You're still up 82%. Year to date, guess what? Year to date, you're up 262%. even after a 16% drop today. So if you hold this stock, trust me, you're not upset about today unless you got in very recently at the highs around 160 maybe. Then you could be upset. But if you have been holding this stock for a while, which I wish I had, and I could show you, I forgot to save it here. I did have a limit order in place for Roku, and I didn't reach the price I wanted it to. This is maybe 2 years ago, and I made a mistake, and I understand that. But this is one of the hottest stocks of all time right now. I mean, we're talking about on a 5-year basis, which, they IPO'd in 2017, so it's not too far. Up 340%, man, since 2019. I mean, since the start of the year, the thing's up 331%. So, this past year has been a tear. It's been on a tear. And I missed out on it. And a lot of people probably did. So this 16% drop really means nothing if you're a shareholder of this company. I mean, it's already extremely overvalued. And my concern is how much it will drop as a result. Again, this is a fantastic quarter, and I think people are going to realize that. And they're going to continue to buy into the hype. It's a hype stock. There's a lot of potential to it. Obviously, streaming being one of the major players in the future. Streaming will take over cable. It's fantastic to have a player in the streaming service like Roku is, where they're just kind of a base to access your streaming services. Everyone's going to need a smart TV once they get rid of cable, which everyone will occasionally. And obviously every TV pretty much is base smart TV at this point, but their main benefit's going to be offering more than the base on some of the other TVs, or just expanding, helping with that TCL brand. I'm only going to mention the important ones: TCL, Hitachi's, maybe a Philips TV. Okay, maybe. Let's be fair here. I might give them credit, but you know what I like? I like a nice TCL or a Hitachi TV. Give me one of those, baby. They need to start selling more of those, and that's really how they're going to get more of this revenue in, because it's hard to sell the streaming stick for people who already have a smart TV, technically, if you think about it. But again, maybe the TV doesn't stream 4K. We'll see. There's plenty of factors here. But yeah, Roku, devastated. Guess what? Next, we're going to talk about a company that's going to go bankrupt. Bankrupt. Can you believe it? Everyone's favorite, Party City, down 60% today. Party City is down 60% today. What is going on here? Party City's getting massacred. This poor company, founded in 1947, will not be making it through the end of next year, guaranteed. This is rough. This is rough for this company. Let's look at this earnings. Roku. I looked at the wrong one. Party City, baby. Party City with a non-GAAP EPS of negative 28 cents and a GAAP EPS of negative $3 per share. What the crap? Revenue declining and missed by 11 mil. Oh, don't listen to that. Shares up. They were not up at any point. I mean, look at this. Oh my gosh. Just look at this stock. Okay, 5 days is pretty well been flat. 1 month, it thinks it's up. I don't know what you're doing here. Don't know what you're doing with the green. Let's just look a year out. Okay, nothing but down. Oh, 5 years out, nothing but down. In its prime. Can we get to the peak? This is since IPO here. So, I mean, this was not a public company for the longest time. IPO'd in 2015. And since then, since the IPO, down 87%. And we've seen this a lot with some of these IPOs. It's rough. They went public to try to raise capital and make money that way and outstand what they were doing. But this is another retailer that's going to be dying, unfortunately. After reducing its full-year profit outlook along with Q3 earnings that fell short of expectations, well short, it did. Full-year EPS of 84 cents to 91 cents versus prior of $1.26 to $1.36. Rough. Consensus was $1.26. That's a very rough cut. Issues with helium supplies and a soft Halloween. Yeah, I mean, if you're going to have a soft holiday season, I mean, if it's soft Halloween, I mean, that's when you're going to should be getting a lot more of your money, and you can't blame that on a weak quarter as a weak holiday. That's not fair. That's what you're here for, Party City. You are here for making money on the holidays, and guess what? You blew it. You blew it. And now at this point, this is a company which blowing through cash, debt already outweighing their total cash by a decent margin already. So it's going to be rough for Party City. I don't see them making it past another year unless they raise capital, which, again, will devalue the stock even more. But, I mean, what can you do to devalue this any more than it is? Yikes. From once a $20 stock to a $2 stock, this is a penny stock now, man. What do you do? Just rough for anyone. I mean, I don't think anyone has owned Party City shares in a while. And now they definitely don't, now that they all sold out and it's down 60%. So, definitely avoid it. All right. Those are some bad earnings for today. There you go.